Dear viewers, for centuries, Indian ports have connected us to global trade routes long before globalization became a buzzword. Even today, close to 95% of our trade by volume and 70% by value moves by sea. That should tell you just how central the maritime economy is to our daily lives, even if we don't see it. Now, this age old sector is being given the kind of attention and capital that could meaningfully change its trajectory. In September this year, the Union Cabinet signed off on a Rs 697 billion package aimed squarely at strengthening India's shipbuilding and broader marine ecosystem. It is expected to unlock over 4.5 million gross tons of shipbuilding capacity and attract Rs 4.5 trillion in fresh investments into the sector. Let us look at some of the companies that are poised to play a central role in this transformation. The first is Mazagon Dock Shipbuilders. Its roots go back nearly 250 years to 1774 when it started as a dry dock in what was then Bombay. It officially came under government ownership in 1960 and today it holds a strategic position as one of the few companies in India capable of building destroyers and conventional submarines. In fact, it is close to a monopoly in the space. Over the years, Mazagon has delivered everything from merchant ships to warships to submarines, and it is venturing into heavy engineering projects connected to the oil and gas sector. It's a company with zero debt, consistent profits, regular dividends, and a strong cash balance on the books, somewhere in the ballpark of Rs 110 to 120 billion, which is around 10% of its market cap. As of now, it's working through an order book worth Rs 323 billion, nearly three times its annual revenue, and the management has guided that this could grow to Rs 1.25 trillion in the next year or so once the submarine orders come through. Of course, the stock isn't cheap. The price is over 54 times its earnings and the PEG is over 2. But the prospects look good and the company's positioning is hard to replicate. The risks exist: lumpy orders, potential execution delays, and margin risk in the fixed price contracts are the key ones to watch out for. Then there is Cochin Shipyard, the company that built INS Vikrant, India's first homemade aircraft carrier. Beyond defense contracts, they are actively building and repairing commercial vessels, offshore ships, and even high-end luxury cruises. About 39% of its order book is focused on green vessels, which ties neatly into the global trend towards cleaner maritime transport. It has also struck up collaborations in Dubai and South Korea to expand into global ship repair and merchant shipbuilding opportunities. Financially, Cochin Shipyard has a robust balance sheet, strong operating profit margins, and almost no debt. The management has guided for a steady revenue and profit growth, and they have been reasonably shareholder friendly with the dividends. The dividend payout stands over 30%. Still, like Mazagon, the stock isn't exactly flying under the radar anymore, and valuations are on the higher side, something retail investors should always be aware of. The third player to keep an eye on is Garden Reach Shipbuilders and Engineers. The company has an order book worth Rs 217 billion, more than 4 times its annual revenue. It has zero debt. The return ratios are healthy with a return on capital employed of over 36% and return on equity nearing 28%. What it lacks in margin muscle compared to Cochin or Mazagon, it seems to make up for it in capital efficiency. It is another PSU majorly owned by Ministry of Defense. The stock's valuation is once again on the higher side, but in a sector where the risks are often about execution and capacity, GRSE has quietly built a reputation for delivering on contracts. There is also Knowledge Marine and Engineering Works, or KMEW. A relatively new entrant, it has grown from a small ship repair unit with a net worth of Rs 1 lakh to a company with a net worth of Rs 2 billion, from one single small asset to 40 dredging and ancillary assets. It started working with one port with a private client, and today KMEW has established itself as a reliable player in marine infra with a solid portfolio. From focusing on dredging, it is moving up the value chain with shipbuilding and repair. It has expressed interest in projects worth Rs 20 billion and expects a minimum EBITDA margin of 35%. The latest unexecuted order book stands at 8.8 billion rupees. This compares to a revenue of Rs 2 billion in FY25, offering strong visibility. The return ratios of the company stand at 25%. The debt to equity is 0.6. Operating profit margins have been in the range of 35% to 40%. The PE ratio is at 47 times and PEG is at 1.36. So what ties all of these players together? Whether it is for defense self-reliance or global trade competitiveness, India is making a concerted push to be a serious global player in shipbuilding. That doesn't mean it will be an entirely smooth sail. Execution challenges, contract structures, cost overruns, these risks are inherent in the industry. But for long-term investors, this may be the space worth tracking more closely than before. Please note that no view is implied on any of the stocks discussed here. Let me know through your feedback if you found this information useful. Thank you for watching. Goodbye.